For financial summary, stay here. For full earnings call recording, skip to minute 2. JKIPL financial results for September 2025 quarter with YOY comparison. Revenue 72.82 crore rupees versus 49.75 crore rupees YOY with a change of plus 46.37%. Expenses 65.79 crore rupees versus 48.16 crore rupees YOY with a change of plus 36.61%. Other income 0.43 crore rupees versus 4.29 crore rupees YOY with a change of minus 89.98%. Profit before tax 5.67 crore rupees versus 4.95 crore rupees YOY with a change of plus 14.55%. Net profit 4.45 crore rupees versus 4.13 crore rupees YOY with a change of plus 7.75%. EPS 1 rupee and 15 paise versus 297 rupees 0.12 YOY with a change of minus 99.61%. Operating profit 7.03 crore rupees versus 1.59 crore rupees YOY with a change of plus 342.14%.
Ladies and gentlemen, good day and welcome to Jinkushal Industries Ltd Q2FY26 earning call. As a reminder, all participant line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. We have with us today Mr. Abhinav Jain, Whole-time Director, and Mr. Sumit Kumar Berlia, Executive Director and Chief Financial Officer. I now hand the conference over to Mr. Abhinav Jain. Thank you and over to you, sir.
Good afternoon, everyone, and thank you for joining us today. It gives me great pleasure to welcome you all on the first earnings conference call of Jinkushal Industries Ltd following our recent listing on the stock exchanges. I would like to extend my gratitude to our investors, analysts and stakeholders for joining us today and for the trust that you have placed in our journey. Today we walk you through the remarkable journey of Jinkushal Industries Ltd, growth and resilience, and share insights into our vision for the future. Jinkushal Industries Ltd began its journey decades ago, rooted in a family legacy of 5 decades of mining and construction. What started as a small equipment leasing business has now evolved into India's largest non-OEM exporter of construction machines, with a footprint spanning more than 35 countries across 6 continents. Our transformation has been gradual but deliberate. Our philosophy has remained unchanged: to create value through trust, reliability, and value creation. Today we operate through an integrated multi-vertical business model that covers every stage of the value chain. Our operations span 3 key segments: exports of new and customized construction machines, exports of used and refurbished machines, exports of a proprietary brand, Excel. Each of these verticals complements each other, creating a strong synergy and allowing us to cross-sell and deliver complete end-to-end solutions, from sourcing and refurbishment to customization, accessorization, and after-sales service. This multi-vertical structure allows us to cater to a broad range of customers, from large-scale infrastructure contractors to equipment rental companies and wholesale distributors and importers, offering them machines that meet different price points, performance standards, and regional needs. Our strength also lies in our diversified portfolio, which includes a wide range of machines such as excavators, backhoe loaders, motor graders, bulldozers, wheel loaders, compactors, cranes, etc. And now we are researching to expand into electric construction equipment as well. And with the right infrastructure set up first, we are going to soon delve into that as well. This diversity not only reduces business risk, but also positions us strongly to tap into emerging trends like sustainable and smart infrastructure. We continue to follow an asset-light approach, partnering with the trusted global manufacturers for contract production of third-party refurbishment as and when needed, while maintaining a 30,000 square feet in-house facility in Raipur as well. This facility, equipped with modern systems and staffed by 42 skilled technicians, is supported by 7 designated service centers in a hub-and-spoke model across India and UAE. Together with a strong network of 220 plus suppliers in a B2B business, this structure gives us flexibility, scalability, and consistent quality control. We enter the next phase of our journey with a clear agenda to accelerate profitability through a high-value product mix, unlock efficiencies in working capital, and scale our international reach. With expansion of Excel and strengthening refurbishment capabilities and a rapidly expanding global presence, we are laying the foundation for enduring value-oriented growth. The successful IPO has fortified our balance sheet and broadened our financial flexibility. Building on the extraordinary 38-fold top-line growth of the past 7 years, we are confident of starting a fraction of similar growth trajectory over the next 5 to 7 years on a larger capital number. Powered by our stronger capital base, enhanced liquidity, and diversified global operations, we are sure to achieve these things. In essence, our journey has been about evolving with the market, growing smarter and not just bigger, and positioning Jinkushal Industries as a reliable, globally trusted partner that combines Indian expertise with international standards. During H1 financial year 26, our operational focus was primarily on improving profitability and optimizing the operating cycle. We introduced better cost controls and improved supply chain efficiency. These actions helped offset a global market fluctuation situation and improved our margins even as top line remained sustained and stable. In addition, we continue to strengthen our global supply and distribution network, ensuring faster delivery cycles and improved machine quality. Our customer relationships, especially in the markets like LATAM, Africa, and Middle East, remain strong and are expanding steadily. A major focus area for us this year has been the strategic expansion of our Excel brand. Excel represents our vision of delivering world-class, cost-effective equipment design as per global top standards and built for emerging markets. With this aim, we have successfully engaged and established new distributor partnerships, including one of Africa's largest equipment dealers, which will significantly enhance Excel's reach and recurring revenue potential. And many more such partnerships are underway. With more working capital available post-IPO and a clear roadmap for scaling Excel globally, we are confident that the brand will contribute meaningfully to our top line and bottom line both in the coming years. Traditionally, the second half of our financial year performs stronger than the first. This is driven by higher export deliveries, stronger demand, and execution of orders from our key markets. We expect H2 of FY25 to reflect better financial performance, FY26 to reflect better financial performance, improve profitability, and healthy cash flows as operational efficiencies continue to play out. Our near-term focus remains on maintaining financial prudence while pursuing sustainable and, most importantly, profit growth. We are committed to expanding our global presence, strengthening brand equity, and creating long-term shareholder value, with an aspiration to cross around 800 crores of revenue in the next 2 or 3 years. But the sharpest focus of ours remain on the PAT growth more than the turnover growth. Thank you. And our CFO, Mr. Sumit Baralia, will now take you through the financial performance of our company.
Thank you, Abhinata, and good afternoon, everyone. It gives me great pleasure to share with you the financial and operational highlights of Jinkushal Industries Limited for the first half of FY26, covering both Q1 and Q2. For the 6-month period ended September 30, 2025, we achieved a turnover of 121.6 crores compared to 119.6 crores in H1 FY25. EBITDA increased from 10.3 crores in H1 FY25 to 16.2 crores in H1 FY26, with margins strengthening from 4.8% to 9% during the same period. Our PAT stood at 11 crores, an improvement from 5.7 crores in the same period last year, a significant growth of 89%. While the top line has remained steady, the improvement in profitability and margins clearly reflects our continued focus on efficiency and margin expansion. On the balance sheet front, debt-equity ratio improved significantly to 0.36 times, down from 0.63 times as of March 2025. Current ratio stood at 2.56 times, reflecting a strong liquidity position and increase from 1.99 times as of March 31, 2025. Sales from our proprietary brand, Hexel, accounted for approximately 11% of total revenue during the first half of financial year 26, with a total of 72 units sold till date. This reflects a significant increase from the previous period, primarily driven by the successful launch of Hexel backhoe loaders. Backhoe loaders have now become our highest selling product, contributing nearly 40% of total sales in H1 FY26 compared to 25% last year. The remaining revenue was derived almost equally from the sale of new customized equipment of other brands and used refurbished equipment. Notably, the average selling price of used equipment has increased significantly, supported by improved product mix and stronger demand in the refurbishment segment. From a geographical perspective, during H126, Mexico continues to be the company's largest revenue contributing market, accounting for nearly 50% of total sales. UAE emerged as the second largest market, contributing 28%. Additionally, South Africa has rapidly become the third largest market for us, contributing 8% of sales following the complete expansion into the region. Thank you, and we will now open the floor for questions.
Thank you, sir. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use headset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Harsh M. from Toro Wealth Management, LLP. Please go ahead, sir.
Yes, sir. Thank you for the opportunity. Just wanted to understand a bit about your business that, now that you've raised funds from IPO and you have good liquidity, what would be the challenges in terms of scaling your business from here on? And how do you differentiate yourself from any other player in the country who is probably doing similar refurbishment and export of equipment?
Hi, great question, Mr. Harsh, I believe. And first of all, I redirect your attention towards the fact that we're a niche player in the segment. There's no apple to apple comparison during the exact 3 verticals that we do our business in. We're the largest non-OEM exporter of construction equipment in the country, and we're a global company focusing on global markets. After the IPO proceeds, our objective to deploy proceeds in the vertical, increase our top line and bottom line both in each of the product segments and categories that we in, and especially strengthen our brand Hexel, which we've been doing so as per the performance in the past 2 quarters as well, and increase our focus on creating brand recognition, strengthening our supply chain, appointing distributors in various countries, which will ultimately impact our bottom line positively.
Okay. And just to take forward the question of bottom line, so there was margin decrease in FY25 in percentage terms. So what was the reason, or was it that the base was higher for FY24 being a one-off year? If you could elaborate on that.
Great. So I believe the top line in March 24 was about 240 crores, and the top line in March 25 was about 380 crores. So such rapid increase in the revenue and top line growth was achieved due to the push that we did in the key markets that we are present and pushing our machine sales. And obviously there was, when you try to scale with such vigor, you have to face margin pressures, and that's what was visible in our numbers and balance sheet. And in the current half ended 30th September 2025, we have again pushed back on the profitability and margin percentage side, and from about 5% earlier, we are at about 9 to 10% on a PAT level margin basis on a same comparable period. So this has been a trend which has been followed in any of the 3 years if you pick from our past 7 or 8 years of history. If you compare any 2 years, either the top line or the bottom line, we have an increased growth as opposed to the other. But if you compare any 3 years in our history of any period, comparable period, you'll always find that our growth has been consistent in a 3-year period on the top line and bottom line basis both. And in the current year, I would like to mention again, our focus is clearly and sharply on profitability and profits.
Got it. So normalized aim 10% PAT margins is how you look at the business over a longer periods of time. Give or take a couple of quarters here and there could be fluctuations, but yearly levels 10% PAT margins is how we should look at the business.
Well, 7 to 9% PAT margins is where we stand, and this is the range that we ideally target. As a growth stage company with vision to grow multiple fold in the coming years, with penetration in the global market, increasing our revenue and top lines will definitely also be needed. We can't just enjoy higher PAT percentage margins at a lower turnover base. So we have to balance it out, and I would say the range of 7 to 9% is where we are comfortable with absolutely zero capex involvement. I believe that is a PAT percentage level which gives us the real comfort.
Fair. Another question I had was around your in-house brand. So that you are getting it manufactured from China, right? And you have what percentage of revenues as of FY25 and as of half year now is coming from your own brand?
So in March, H1 25, we had about 8 machines sold of Excel, our own brand, and in H1 2026, basically September 2025, we have about 35 machines sold of our Excel brand. And as Mr. Sumit, our CFO, also pointed out that till date, we have sold about 72 machines, which has seen an incremental jump on that figure as well. So in about 120 roughly odd backhoe loaders, 40 backhoe loaders that we set now of our own brand. So I believe more or less about 25-30% up from 2-3% of our revenue in the backhoe loader product category is coming from our own brand now.
Got it. That's good to know. And which key industries are you catering to in these markets in Mexico and UAE and Africa? What are the end use of these, like this construction, or there is mining also, or some other industries?
Well, both these machines are capital goods in construction and mining equipment. These are the easiest financeable product in the entire world, and that's why they always have a high demand. They're in the primary sector lending segment globally, and our end users, we sell to B2B distributors or importers or wholesale buyers of these machines, just like any other import-export business works. We don't sell D2C, we sell B2B, and our importers and buyers then sell these machines to the end users at the last mile point in their time zone, in their language, with their regional support. And we cater to these customers of ours, who in turn cater to the contractors, mining companies, construction contractors, government contractors, etc. And out of the 200 odd countries in the world, hardly 20-30 are developed, and the rest 170 are underdeveloped, which are always having a demand for development. either it could be fast in 1 year or slow in 1 year, but there's always going to be a sustainable demand for development, and it's a 10 lakh crore industry of the global used equipment market size in 2024 growing to be in 2029 about 16 lakh crore. So the size is big. The industries that we cater are basically everything is covered in the 10 lakh crore basically. So even your industries, your steel plant, your factories, they need something or the other. Your rake loading point, your agriculture business also needs loading of grains on trucks, etc. So these construction, mining, agriculture equipment, they are versatile equipment used everywhere basically.
Got it. And just last one question. Any company globally that you look up to as an aspiration?
Well, there are a few global companies that we look towards aspiration. They are a multi-billion dollar company and kind of the global leader and monopolistic player in this space. I would like to refrain from disclosing their confidential information in the interest of our business or trade secret, I would say, but we're happy to take that one-on-one. But yeah, there are a few companies, but hardly companies who have the reach and network and the global outreach of our size, being present in 35 countries with across 6 continents. So that gives us a very big headroom that we are the number 4th or 5th player right now globally, and we are not that big. So we have a good room to cover. And the next upward players are all multi-billion dollar companies.
Got it. Thank you so much and best of luck.
Thank you, sir. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Thank you. Our next question is from the line of Vignesh Iyer from Sequent Investment. Please go ahead, sir.
Hello. Thank you for the opportunity. Sorry, sir, I missed your earlier comment. What percentage of our sale comes from our own brand?
Well, as we had in the last half of the previous year, sold about 8 machines out of the total 191 machines in the previous half. So now in H1 26, we have sold 35 machines out of the 192 machines sold totally. So that amounts to about, I believe, I'm missing the percentage exactly, but it will be something 20%, 15 to 20%. Yeah, 15 to 20%. 35 out of 192 is current half. Previous half was 8 out of.
Hello.
Is that answered?
Hello. Yeah. Got it. So my next question is, so is it one of the reason why we are seeing increase in margin when we have to compare YOY basis? Simply if I compare the Q2 numbers, because the revenue number, the net sales number is more or less, not much growth is seen, but we see a big jump in EBITDA. Is it primarily because of shift from refurbished to own brands?
On the contrary, we have seen a profitability in the early years of any new brand establishment. The profitability of new brands do not get settled in initially. However, our strongest suit is our used and refurbishment business sector. In the H1 2025, we had about 51% by value of our new and other brand customized machine sales, and 45% by value of our used and refurbished machine sales of other brands. On the contrary, we have deliberately and physically taken calls, and in H1 2026, we have 46% by value of our used and refurbished machine sales, as opposed to 43% in value of other brand sales. So we have actually increased these refurbished and used machine sales, and other brand machine sales has been transferred kind of to our own brand sales of new machines. And this is the primary reason why we have seen an increase in the profitability and profits, because on used and refurbished machine sector, we earn about 12 to 14% on a PAT level basis, and on new other brand sector, we earn a lower value than that, of course, by logic, because value addition is more in used and refurbished machines. And however, the absolute value, the sale price of new machine of any brand is higher, and compared to the same machine, used and refurbished machine will be lower. And that also reflects exactly on the turnover side, why the profit has grown while the turnover is not, because used and refurbished machine sales has increased.
Okay. Okay. So one last question from my side. Just wanted to understand more on the invoicing part of it. I mean, we, we manufacture, I mean, we don't manufacture it, we outsource it to a a factory in China to manufacture this, and some part of it gets exported. So just wanted to understand how do the Chinese invoice us, and how do we invoice our export companies in terms of which currency?
Excellent question. So it's a policy initiated and promoted by the government of India. Recently, we had given a corporate news section as well, showcasing how this is good for big export houses in India. The government of India is promoting Indian export houses to become global players and not just domestic exporters exporting from one country. They want their strong export houses to really become global players. That's why they have been supporting merchant trade transactions. So it is a simple process where someone else from a third country sells their product to us. They basically invoice their product to us, and we take that into our inventory or stock or book, and we sell it ahead to some other person or other fourth country, and the goods never touch India, which again is in line with the promoted policy of the government of India for Indian exporters to become global exporters and global powerhouses.
Okay, but the currency remains the same. I mean, is it USD? Okay, so okay.
It is the choice.
Sorry, your voice is breaking. Sorry.
So it can be anything. It is primarily in USD, US dollars,
okay.
But it is a choice exporter to use whatever they want to, just like any other export flow. It is normal export basically.
Okay, because if I understand it right, we are naturally hedged that way, right? I mean, we are importing in USD and exporting in USD.
Some portion of natural hedging as well, but we do have because we have exports from India as well, where we are buying from China for so we do have that segment vertical as well.
Okay, got it, sir. That's all from my side, sir. Thank you.
Thank you.
Thank you, sir. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Arvind Singh Chaudhary from RMO House Investment LLP. Please go ahead, sir.
Hello? Hello,
yes.
Am I audible?
Yes, Mr. Yes.
Good afternoon. Congratulations on a good set of numbers. Basically, I have two questions. The first one is that there are a lot of auctions going in mining sector. So do you have plans for any mining equipment? And the second one is that the 7 delegations from Australia are coming in India from 26th October to 3rd of November. Do you have any talk with the delegations for technical collaborations?
So I'll answer your first question. We don't intend to take on any mining contracts directly, but however the opportunity may come, and as long as they complement our primary core vertical of exports of used or new construction equipment, we may explore opportunity. And the delegation from Australia is something that I was not aware about exactly, honestly. Maybe they are not exactly from the field of business or work that we are in. Maybe they are from some other field or some other mining sector. So we may explore that opportunity, and probably I can give you an answer after exploring who is coming exactly and what is their agenda.
Sure. Thank you.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Raj from Arjo Partners. Please go ahead, sir.
Hello, am I audible?
Yes, Mr.
Yes, sir.
Sir, I wanted to know our segment-wise sales and EBITDA?
I'm sorry, can you repeat the question, please?
Hello. I wanted to know our segment-wise sales and EBITDA, like how much sales from the new equipment, how much from the used ones, and how much from our own brand in H1 FY26.
Sure. So about 51 crores of new equipment of other brand sales has been there in H1 26. About 55 crores, 55 crores of used refurbishment machines of other brands in the current half, and our own brand about 13 to 14 crores. And
13, 14.
we are focused at level margin usually, and I would again say bring it back to the point that 2 to 4% on PAT level basis is where we target new equipment of other brands. 12 to 14 is where we target used equipment of other brand, and for Excel, our own brand, it's early on, but there are many first time, one-time operation cost as we expand. But going forward, we can easily eye about 12 to 15% PAT level margins as our brand grows and gains traction.
Okay. And sir, in our Excel brand, we manufacture it from China, right? And then we import here and then we sell it. That is the business model. Okay.
No, we don't sell it. Do not import the Excel brand. We just get it contract manufactured from China and then sell it across to various countries all across the world.
Okay. And sir, as you said earlier, in Excel brand, you till date you have sold around 72 equipment, right? And out of that, 31 are sold in H1 FY26. Sorry, 35 are sold in H1 FY26 compared to 8 machines in H1 FY25, right?
Correct.
The
difference of FY25, some in the current of October of FY26.
So the average selling price of Excel is around 40 lakh rupees.
I'm sorry, what?
The average selling price of Excel brand equipment is around 40 lakh.
More or less, yes.
More or less 40. And sir, how much would be the average selling price of our peer in the same category of equipment? And what will be our USP in the brand, Excel brand? Like, do we compete on the price, or do we compete on the quality, or do we compete on our reach?
So it's a multifaceted and a good question. First of all, I'd like to tell you we are selling machines across 35 countries in 6 continents, which is a rare feat, and brands with or companies with very large numbers or capital bases are able to achieve this feat of distribution and network of selling in this. The entire reason that we launched Excel brand was our engineering expertise and our engineering excellence and overall mechanical engineering expertise of India as a whole was with us to leverage, and the sales network was with us to leverage. And then we were able to understand the customer pain point of what exactly goes wrong in our construction equipment, because remember from the past 5 decades my family has been involved in the mining and construction activities in south of Chhattisgarh. So this was something that was very important underlying factor which gave us immense insight on what are the pain points of customers. And just like in a crowded automobile market, some good and upcoming brands launched cars and car brands and disrupted the entire automobile market internationally. We also thought that, with our engineering background, with our 5 decades of experience, my father is a mechanical engineer, I'm a mechanical engineer, and my colleagues are working in the US in the globally, popular construction equipment companies. We collaborated with them. We have a US office as well. And then we designed and turned the customer pain points into engineering solutions. And we really were able to do it at a cheaper cost. Us being Indians, we always, Jain Marwari family saving money at every step of the way. So we were really able to give great value to our customers. Now about the price point comparison, you have to compare the price in the destination markets that we are selling. And we have adequately placed our prices, competing. First of all, in the features, in the value, and then after giving great price for the features and value. And these are commercial and construction industrial equipment which ultimately give productivity to the customer. So when they get so many things on scale, because one customer buys multiple machines, ultimately productivity gets increased, his costs get decreased, his cost of ownership gets decreased, so he's liking the machine. The quality of construction, the design, the engineering, everything is good. But the biggest USP I would say is the after-sales service quickly. India and China being so big automobile hubs these days in these couple of years, we are able to service and provide after-sales service in spare parts very quickly. Like we have a saying that 90% of the spare parts that we have that the customers require usually after they giving the details in a proper format, we dispatch them within 48 hours. So this cuts out the whole corporate and large process of the parts going from maybe China to Singapore, then to Houston, then to any South American country, or maybe Dubai, then Hong Kong, then African country. So we are at D2C in the aspect of spare part delivery. That is the biggest USP, that the customers don't get downtime. They are getting good results for that. So this is why our machines, are being demanded. And the other key aspect is we don't earn a lot on spare parts. Everyone in the automotive or construction frequently knows there's low single digit margins on the sales of machines, 10x or 50x on the sales of spare parts or after sales service. This is the biggest gap we are in. Now we are just selling spare parts with bare minimum margins because that's not our core focus or business, and we are just supporting our customers for that. So this has turned the whole industry on its head, and this is why we are beating the most popular brands you can say out there in the destination.
I understood, sir. So our price is comparatively lower than our peers, right?
Our sales price is lower than our peers, but also the most important aspect is our spare parts is very, very low than our peers. So the total cost becomes extremely low. And at the same time, feature rich and latest technology, AI enabled machines with AI assisted, operator assisted features, human detection cameras, etc.
Alright. So sir, by how much range will our price be lower than the peers?
So I would
Any
say
rough estimate you can give?
40% is the price difference when you compare apple to apple, single configuration, single spec, similar operate machine of any other popular brand. Different brands will have different price range difference and in different markets, but I would say the average would be anywhere between 20 to 40%.
20 to 40% lower, okay.
Yeah, on capital goods, that's a thing because these are heavy size products.
Understood. And sir, in next 2 to 3 years time, you commented you want to reach sales of around 800 crores, right?
Right.
In FY26, you will close around 250-260 crore of sales. So you are talking about 3.5-4 times increase in our sales, right? So what gives you this confidence to reach 800 crores of sales? And sir, at 800 crores of sales, what would be our segmental breakup of sales?
Sure. So actually, Excel brand will increase. The new customized machines share will be taken up a little bit more by Excel. Use them refurbished machines, which is our main core business, will remain to be present. And however, I believe so far the numbers that we have achieved have totally been without capital. We've only got listed this month, less than maybe 20-25 days ago, and maybe there is 18 working days. So we have not really been able to utilize the entire working capital that we have used. So having these numbers and March 25 with 380 crores in the last year, with a lesser capital availability and with incrementally extra liquidity available with us, I don't really see a problem for us to achieve 800 crores of revenue in the next 3 years. For achieving 800 crores of revenue, we need about 300 or 350 crores of working capital overall, including our own, including equity, including working capital limits that we have from the bank. So I believe about 200 crores of equity after the IPO, including our own net worth and the equity raise has been there. And then with the working capital lines of the bank, we can really reach that figure. And then turning it around will not be a problem given the diversified product portfolio that we have, our own brand that we have, and the diversified customer geographies that we serve in. So that really, 3 guna of the working capital and 9 guna of the working capital in an export market is quite, not a far reach, right? But our focus is never on the turnover. It is a range that we want to reach on turnover basis to, to set a benchmark for the penetration and reach or size. But our focus is always on the PAT. Ultimately, घर में पैसा कितना आ रहा है, that's what we focus on. And 35 to 40% of CAGR on PAT level is what we really intend to grow at in the next 3 years. On an absolute basis. Turnover कम ज्यादा होगा तो चलेगा, but PAT is something that we focus on. हमेशा historically grow करते रहे हैं, and we want to grow the
35-40% PAT CAGR, 3 to 4 years बोल रहा. All right, sir. Okay. Yeah. Thanks.
Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Vignesh Iyer from Sequent Investment. Please go ahead, sir.
Thank you for the opportunity, sir. Wanted to understand, dynamics on your own brand versus the refurbished. You shared the numbers in terms of what own brand machine you have sold in H1 FY26 versus H1 FY25. Wanted to understand, is it, the same customers who were earlier buying refurbished that they have shifted to Excel brand? And what was like the timeline before your own brand machine got approved by the same customers? What is the general timeline to just to get an understanding as to if you intend to scale to 800 crores, 900 crores revenue in future, we might need newer clients addition and there would be a certain timeline for your product to get approved. So if you could share your insight on the same.
Sure. So it's about the sales pitch that you're talking about, the timeline for sales pitch. It can vary anywhere between 15 days to 3 months or longer sales cycle. Some customers, it's like a car. Some customers just go to the showroom and buy the car. Maybe in 1 day or 1 week, and some customers take time of 3 months. With the IPO proceeds, working capital and general corporate purposes, we are increasing our team, we are increasing our professionalism within, the whole system and hierarchy, and new business development will definitely be the primary focus since we are a new brand. It was easy for us to sell these machines even without any of this present, with a lesser working capital because we had the great distribution network, and some of our used equipment buyers are definitely choosing to buy these machines because they are liking it, they are getting good customer feedback, and they are getting those machines sold already. And then word of mouth, marketing, those efforts also play. Of course, when we are launching a brand, these things will come into play. When we raise capital, we are going to spend in these things, which will ultimately result in new customer acquisition as well. So I can't give you an average timeline because there are so many countries involved, and each country will have a different timeline, different time zone, different culture, different dynamics. But the entire aim is to achieve, 50 distributors of Excel globally, as opposed to currently 60 or 70 odd B2B customers that we have globally. I believe about even 20% of them get converted to Excel distributors, and then that would become about 15 to 20 customers. And other than that, we have to acquire 30 more customers in the next 3 years. And then even with the average annual machine volume of 20 machines per year, 15 to 20 will make it 1,000. So from zero Excel sales currently, we can have about 1,000 Excel machine sales, which will add to about 300-400 crores of turnover right away, which is zero right now. So this is our clear intention. We have been moving in that path. We have recently acquired a distributor in Africa, South Africa, which is the biggest distributor of Africa, which is 5 decades old as well. So we're in the right trajectory, right path. We're adding employees, professionals who are from the industry, who have the experience of appointing distributors globally, who can go out there and appoint and do sales. So obviously it's a 10 lakh crore market as a share of used equipment, used construction equipment. So new construction equipment is even there in larger machines, or at least the same amount. So of course there are so many other customers whom I have probably not been able to reach out, or we have not been able to reach out as a company at this level. And by hiring professionals, we can do that. And we have professionals now. We have employees and sales managers of 3 or 4 different nationalities in South America, in Africa, in Dubai. So we are doing that outreach, and we are we are on the right trajectory, I would say. The numbers speak for themselves, right? About 160 में से 40 में हमारी एक्सेल की बिकने लग गई है. So of our total tobacco to the category. So I believe share is going on the upward trajectory.
Okay. Okay. And when it comes to, if you could give your insight of any volume growth expected in FY26. H1, if I read it right, H1 FY26 versus H1 FY25 more or less flat. Just that Excel as a part of total sale has improved. So, what our strategy for this year would be to increase the penetration of Excel as part of total sales, or are we seeing some volume growth that possible in Excel?
Growth has a razor sharp focus this year, even in the first half, and we remain to do so even in the second half. We want to achieve that, as I said earlier as well, any 3 years of our company's existence and history, if you see, in alternating years, we have once increased our penetration and top line. In the alternating next year, we have increased our bottom line. If you see FY23 and FY24, again the turnover was flattish, but the PAT grew 2 times. So I believe we are at the same kind of cycle stage here this year when the the turnover can be flattish, but we have seen PAT to grow almost 1.5 to 2 times in the H1. Comparable H1, right? So we are I think on a similar track, I can say. And it is not something new. It has been going on in our company's history in alternating years in the entire 7 years whenever you compare any 3 years. Not just this or the previous, any 3 years. Because it's a heavy equipment business, takes larger working cycle. The machines itself are bigger than our rooms that we are sitting in. They take a lot of time for delivery, etc. So any strategy to implement will take time to reflect on the balance sheet. That's why it takes 2 years or 1.5 years to have that entire thing implemented. So on a macro level, I would say. So that's why 3 years of our company will always give you better growth direction and trajectory rather than any 2 years. In 3 years, you always see the PAT also grows and the top line also grows. This is what my point is.
Right. So just one last question from my side. I've seen last 2 years our tax rate for FY24 has been 25% on consolidated basis and 20% in FY25, and even in the first 2 quarters it has varied a lot. So what would be a steady state tax rate for the entire year?
The tax rate you mean to say?
Sorry?
You mean the taxation?
Yeah, taxation rate has been 25% in FY24 and 20% in 25.
Subsidiaries in Dubai and in the US, right? So because of that addition of the subsidiaries, and Dubai has different taxation than India, which is why you are able to see the differentiation in tax rates. Currently, we don't really see any, unless the taxation changes in these countries, I don't see any reason to have the tax rate change.
No, I mean, so it would be 20-25%, right? I mean, on a steady state basis.
Yeah, I think so.
Okay. Okay, fine, sir. Thank you. Thank you for the answer.
Yeah. Thank you.
Thank you, sir. Ladies and gentlemen, anyone who wishes to ask a question or press star and 1 on their touchtone telephone. Our next question comes from the line of Mangesh Kulkarni from Aman Finance Service Limited. Please go ahead.
Hello, am I audible?
Yes, sir, you are.
Yeah, so in the last question you mentioned about the flattish growth expectation in this year on the top line. But at the same time we are mentioning about substantial growth potential of looking at our past trajectory of 7 years. So is it worth to assume that we will be achieving around 1,200 to 1,500 crores in the next 5 to 7 years, looking at your statement in the last press release?
Well, about the flattish growth, again, I would like to redirect everyone to the fact that these 2 years compared to focus on that one, we focus on the turnover one, very layman in because the entire industry, when we penetrate a market, that improve our margin by next, in any case, if you see the PAT and turnover both have grown at healthy levels. No one can complain. about double-digit growth in PAT, higher, not just lower double-digit, reasonable enough double-digit growth in PAT turnover. In the next, if you say 7 years, definitely our target is to grow 10 times, I would say, from here. That is what we aspire to be. A lot of factors will come into play, a lot of and lot of things we'll have to learn. But we are a company which is always very clearly focused on growth and not going to stop. There will be hurdles, which is in particular year or so. But ultimately we come and we beat all those hurdles and hindrances. And the vision is clear to, from March 25, it's about 380 crores. We really want to have a growth in the next 6 years. If not 38 times, it's on a smaller number in the past.
Hello, your voice is cracking.
I'm sorry, sir, to interrupt you, but so your voice is cracking. Yes, exactly.
Was I clearly audible, or should I repeat the entire thing again?
No, at the end, like 30-second or 40-second back, your voice was fluctuating.
So the vision is clear. In the last 7 years, we have had about 38 times growth on top line. And in the last 7 years, any 3 years if you pick, in any 2 of the 3 years, you may see 1 year the PAT has grown or 1 year the turnover has grown. But if you pick up any 3 years, we have had healthy levels of CAGR growth of revenue and PAT both always, which are reasonable enough and sustainable enough if you compare the 3-year period, start of the first year and end of the third year, any 3-year period. And in the next 7 years, of course, the whole purpose of IPO, incremental working capital efforts and the launch of our own brand, focus on the used and refurbishment sector as well. And given the fact it's a 10 lakh crore market, we definitely aspire to be growing, 8 to 10 times, I would say, from our previous financial year to in the next 7 years. And the market is big enough. We are raising capital, and there will be a lot of factors to play. There will be a lot of things to see. But if all the boxes are checked, we definitely aspire to grow 8 to 10 times in the next 7 years.
Okay, sir. And I just wanted to know about what is the approximate time taken for the refurbishment of the entire machine, and how the turnover is booked? It is based on the order books, or how like?
Turnover is booked upon the dispatch and the sale. When the e-invoice and everything is there, e-way bill, all those things are there. When the machine is dispatched, that's when the turnover is booked. We buy machines, we refurbish them. When the machine is ready and dispatched, that's when the invoice is booked. And I'm sorry, I missed your first question. What was it again, please?
Approximate what time it takes for the refurbishment?
So a headlight टूटा है कार का या पूरी कार चपट गई, it depends, right? So depending on the degree of refurbishment, it can take anywhere between 1 week to 3 months, 4 months, 6 months also. Depending on the degree of refurbishment, the size of machine. ट्रक है कि कार है, ऐसे समझ लीजिए, आपकी एक्टिवा है.
Okay. So any plans to look at the domestic market opportunity?
Well, we are a global company. 10 lakh crore का तो global market size है currently. And dollars में earning कभी भी करते हैं तो it's promoted by the government of India. It always gives you better margin because the cost of labor is cheaper in India. So we are currently exporting our trust and engineering expertise from India. And when we are a globally large enough company, and we will see India as one of our markets as well when we are that size. But currently the global demand ही cater करना है, वहीं पे ज़्यादा profitability है, like any other export business.
Okay, sir. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, in the interest of the time, that was the last question. I now hand the conference over to Mr. Abhinav Jain for the closing comments. Thank you, and over to you, sir.
Hello. So as we look ahead, we take pride not just in our results, I would say, but in the culture that we really have created and that drives it. And a culture built on discipline, trust, and innovation is always going to prosper, I think. So Jinkushal Industries is not just a machinery exporter, it represents India's global competence in manufacturing, refurbishment, designing, engineering expertise, and value creation. I take this opportunity to thank the entire team, our partners across continents, our investors, and all our stakeholders for their continued confidence and support. We remain optimistic and focused on delivering another year of strong performance and steady progress. With this, I would like to conclude. Thank you.
Thank you, sir. On behalf of Jinkushal Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.